But instead of liquidating myself or paring down my equity stake, I could raise short-term debt, and which is what we did. We've effectively reduced that. And so that debt that we took on our books was not for the purpose of Amit Goenka as a promoter, but was to allow Nisus Finance as a company to acquire the construction company. So effectively, I created a pledge on my shares to a certain extent, allowed the company to borrow against that pledge. That allowed us to then go ahead and acquire this company, and of course it has become a great acquisition, and which also immediately, because the company has significant cash flows, has reduced that debt to half, is effectively going to kill it over the next few quarters, and that will eventually release more of my share pledge, which has anyway come down significantly. So that was the first time we actually really went into any borrowing mode, and which is why we got ourselves credit rated also for the first time, which was a very fantastic outcome. So while leverage is important in our business, we actually don't need too much leverage. Okay. Second is, as far as entrepreneurial goes, again, I'm trying to deleverage it. See, because it's a volume business, it's not a margin business, and you're effectively generating anywhere between 10 to 12% EBITDA margins, maybe 14% if you're doing value-added construction. Now, the difference between your EBITDA margins or your operating margins and your profitability will finally depend upon your cost of borrowing and your leverageability. And that can shrink it massively if you're over-geared. And which is what the opportunity we found with this company, that we can actually massively change its gearing structure. We can actually massively reduce the total debt overhang in a very short period of time, because there is a lot of assets on the book. You just need to unlock it. There's a lot of fixed assets. You need to sell it off. You don't need them, right? There's a lot of guarantees which are outstanding, which you can be reduced. There are income tax refunds, which we didn't get for 2 years, and suddenly in 2 months we got it back. So it's just about focus. Can we get this back? Can we get this back? Can we get this back? So there's a lot of value sitting on the balance sheet, but it is locked in the balance sheet. When you start unlocking all of that, effectively your debt starts becoming zero. The good part about the sector is, and the way it was also running in the UAE, is that you actually don't need bank debt. You must have some, because you need guarantees, you need working capital, you need to accelerate, you need to move the order book from a current 2,500 to 10,000 crores of order book. So you need some gearing. But the cost of that will come down, and the need for that will come down over time. So debt is most effective when it goes into a large capex. Because it helps sort of leverage your asset. It helps you build a large asset. Like we took leverage to build this asset, which is acquisition of a company. But it must be manageable to it must be pared down very quickly and kept constant at a very small ratio, which is only enough to keep it running without really destroying your earnings or your profitability.
I want to get a macro picture from you, since you're in this business. How do things like interest rate changes or any other macro changes, for that matter, even SEBI regulations, because you're, a fund management firm, how do these things affect your business, and how do you view them? Because again, because it's real estate, you're very dependent on things like interest rates. At the same time, you're a fund, so you're also looking at what SEBI is releasing in terms of regulations, circulars. So I just want to understand your take.
No, absolutely. I think key economic policies, policy rates, regulatory actions are obviously very, very strong determinants for how we're going to continue to scale this business, and what is going to be eventually our profits and our margins, and what we can deliver to our investors. Having said that, one thing is for certain is that policy rates have usually helped us. When there is an interest rate tightening or when there's a liquidity crisis, we become more popular. There's a need for people to go to alternates even more. In low interest rate cycle, obviously the demand becomes lower. There's some amount of yield compression that happens also for us, because we do maintain a spread over policy rates. So banks will maintain a spread of, let's say, 400, 500 bips over policy rate. We will maintain another 400, 500 bips over policy rate, which is why a second fund, which typically our funds have done 20% plus, actually fell to a 16-17% return during COVID time, because the policy rate suddenly fell for a period of 1 year. It was the lowest interest rate regime in the country to help the COVID environment, and therefore correspondingly our portfolio yield also compressed. Also, the demand also became slightly more muted, because people are afraid to borrow when they don't see visibility of business. So those become, but having said that, because it's structured credit, one is able to today curate a solution which is able to actually match the outcomes for projects. Which banks can't do, which NBFCs can't do. They need to get paid interest every month. They need to get their EMIs done. They need to get returns in a certain period of time. So as a SEBI EIF regulated fund, we have a far greater flexibility on how to structure our credit. We've done listed credit, we've done unlisted credit, we've done private lending, we've done all sorts of things. We've partnered with ARCs, we've partnered with other institutions, including larger government-led funds. So because it's solution capital, and therefore the ability to actually curate the outcome becomes slightly more agnostic to policies. or at least policy rates, because you're able to find something which is eventually going to happen over the next 2 or 3 years, and then work your product accordingly.
So in a way, by customizing solutions, you are being able to manage the risks associated with cyclicality.
Absolutely, Mubina. I think that's one part. Second, when it comes to SEBI, I think one thing is certain: we will never do business which is not regulated and has not seen enough regulatory intervention.
Okay.
So even when AIF came, it was the best thing that ever happened, because so far people were not sure how to actually run pooled vehicles, either through a PMS or through a VCF. So when AIF came, I knew this was going to be a game changer. We are the first AIF fund manager in the country to actually apply and get an AIF license, become an alternate fund. And so being a fund manager for the last, now it came in 2012. So for over 14 years, we've been actually managing AIF funds. So therefore, we have that track record. Also, when fractionalization happened, I did not enter that space because it was unregulated. Likewise, when people started to do other sort of distribution business, we did not get into it because it was unregulated. And I know regulators will sometimes react and not proactively build regulations. But when they react, you don't want to be on the wrong end of the curve, right? You can pretty much kill your business.
Yeah.
So we never got into activities which were unregulated. Today, when an SM REIT regulation in place, today we have the ability to actually do fractionalization through an SM REIT model. So that's a great thing to do. So I think regulations are very important, and they have to be tried, tested, and understood really clearly. Second is, I think SEBI has become very proactive. They've always been a great regulator. But obviously, when you set up a product, it takes time also for the regulator to understand how a product will actually behave. What could be the challenges? Today, the way they have created the framework, which is constant audit, constant checks and balances, constant queries, constantly understanding whether you're doing a fair job in line with your regulations, is become a standard feature. Earlier, you used to never see SEBI's face after you got a license. Today, they're in your face 24/7, which is amazing. So I think a lot of compliments to the way regulators work. So, and I think more importantly, because we've kept governance at the core of our business, their changes in regulation never affected us. So, for example, they prevented evergreening. You cannot roll over your investments or loans from Fund A to Fund B, and therefore keep on evergreening and not have NPAs. Just the way banks did, right? We never did that. So, I was very happy that it happened. We need to constantly value and report. We did that. So, we were very happy that finally they are asking the markets to also behave in the same way. Disclosures of how much is your money, how much is others' money.
You're ahead of the regulatory curve.
So I think it is, when you're doing your business with the highest levels of integrity, governance and reporting, then these regulations are a great welcome change, because it means that those who are getting extraordinary benefits for not following rules are falling in line. And because we're already in line, we know how to really work the ropes. So there's no cost to that learning. So I think generally, I think the regulators have been doing great. And of course, so I think the outcomes have been more positive than not. And again, because you're in constant discussion, you know how the regulator thinks. You know what they don't like. You know what they like. You know what they expect. So when you understand the spirit before the letter, and you start following the spirit, you're always going to be on the good side of the regulations.
Fair enough. All right. My last question to you. I mean, you've noted down what your ambitions are for Nisus, for NCCL. I'd like to understand a little bit more about your team, because, of course, even your team, which mostly, I'm sure, consists of real estate experts, investment management experts, they're the ones who have to take forward the business as well. So I'd like to understand who forms a core part of your team. Is there perhaps even a succession plan in place, if there is one in place?
I think it's a fantastic question, and I think that's one thing which keeps me awake, is succession planning and leadership building. We do have a significant leadership team in our company, and very, very proud of that. We built team over several years, and I think it is to do with what I have faced and what I need my team to have. So, for example, most organizations have very, very strong rail guards on what can happen or what can't happen. It kills innovation. It kills the liberty to actually scale or do things that make sense. So I think creating empowered teams has been one of my biggest joys of life, is finding the right people, getting them empowered, getting them to build their teams, giving them the flexibility to celebrate their failures and celebrate their successes. So I think that's a very important part. And again, when you start giving people the liberty, and I think it's very critical for me that everybody in the organization must do everything that the organization does. You got to be involved in sales and marketing. You got to be involved in credit underwriting. You got to be involved in regulations. You got to be involved on the legal side of things. You got to be involved on the media side of things. You got to be involved in the public fora. You got to interact with the industry and go out and meet people. So when you do that, you start realizing that some people have strengths in domains that they did not come from. somebody was great at marketing but was a financial analyst. Okay, somehow he never thought that he could actually also sell, or he could market, or he can present so well. So when you see that, you are able to unlock truly what that person is best at, where his joy lies, what makes him happy and glued to his work, rather than trying to run away from his desk at 7 p.m. or 6:30 p.m. So I think that ability is something that is a constant endeavor, and people have rotated themselves, they found the right spot, they've done what they really like, and accelerated themselves to do that while working in a cohesive environment, because they've gone around and done everything else. So now they can seamlessly talk to their peers. They're not afraid of talking to legal or accounting or compliance, because they know exactly what these guys do. They've been part of those journeys also. So I think that is where the value lies. That's where the appreciation for your peers is, where the mutuality is, and therefore everybody jumps in when there's a problem. They're not saying, "What's your job? If there's a compliance problem, go deal with it." Everybody becomes part of the problem and the solution. And I think that's where the enablement and the joy is. And I think that's where we create enabled teams. And of course, sharing successes. We believe that success should be shared bottom up, not top down. Typically, leaders like to wear the hats or the crowns or the sashes, but we allow the teams to wear that first. They are the ones who so when you work with the lowest denominator in wine and the highest denominator last, and when the leader is just effectively a mentor and a guide and not a manager, that's when people feel responsibility, accountability, power, and the enablement to do what they really want to do in their life. So those who really want to do something and love what we are doing and are able to sort of do more of it will definitely stay with us forever.
All right, super. Dr. Goenka, thank you so much for your time, sir.
Thank you, Mubina. It was a pleasure talking to you, and all the very best.
Well, there you have it. That's Nisus Finance for you. Do remember, folks, that this is not to be construed as investment advice. Kindly conduct your own research. Thank you so much for watching, and stay tuned to SmallCap Spotlight.